All right, welcome to the Money Puzzle. I am Brian Ramsey. That is Chris Vaughn right there in front. That's Eric Douglas here in the back. And Aaron's on the phone, or he'd be joining us too. Actually, I think we got him on the next one. But anyway, so today's a fresh new look. We just started this a minute ago, and I totally forgot to talk about it. So we redid this.
Completely forgot.
I totally forgot. But anyway, it's our new digs. We're pretty excited about it. Hopefully you guys like the color scheme. For those of you who are regular watchers. Anyway, that's it. It's kind of
If
cool.
you don't like the color scheme, we're not going to redo this. It was too much work.
Yeah, and if you don't like it, Chris is the one that picked it out. Just saying.
Blame me.
Yeah, just saying. All right, so anyway, today's topic is a pretty prevalent one, right? This is something we've been talking about on and off for the last 30 plus years, but it's really come into view in the last 9 months.
Yeah.
Would you not say that's probably fair? Questioning it.
There's definitely been a bigger significance placed on whether or not a 60-40 type of moderate portfolio, which has basically been the bedrock of our industry, right? Whether or not that's going to continue to be the bedrock or the foundation of how we build portfolios.
Yeah.
Yeah. So why don't either one of you? Why don't you guys spend a second and explain when you say 60-40? It's a lot of jargon in our business. And
Okay.
Sometimes you see it, and people are like, I don't really know what that is. So maybe spend a second talking about it.
It's very simple. When you talk about a portfolio and you see those two numbers or you hear those two numbers, the first one could be individual securities, could be ETFs, mutual funds, anything, but it's based on equity. So eventually, as you drill down, you're dealing with stocks. The second number would be based on the income side. So same thing. Eventually, you're drilling down to what is essentially bonds. So historically, the way it's done is the higher the first number and the lower the second number, and they have to add up to 100, obviously. The higher that number is, the more aggressive the portfolio is going to be. The lower the first number, the more conservative it is. So that 60-40 that's what so many people have used. Like you said, bedrock's a good word. That's the one that everything is kind of geared towards. And then you expand out from there. Okay,
so give us an example, like an aggressive portfolio would be.
So an aggressive portfolio, historically, you're looking at typically about a 90-10. There are some 100 zeros out there. You don't drop too much below the 90 and still call it a really aggressive portfolio, but some people will take them down to, say, 80-20 or 85-15.
Typically, I would say about an 80% allocation to stocks or stock funds is going to be pretty aggressive. Is typically the way I've always defined it.
Yeah.
That 60-40 is kind of defined as 60% stocks or stock funds, 40% bonds or fixed income assets. That's going to be your more moderate allocation. And the idea, obviously, is that you're taking a little bit more risk with the 60% with the stock funds, and then the 40% fixed income, that's your diversifier, that's your hedge. So what's supposed to happen in years like this year is your hedge is supposed to zig when your stocks are zagging.
Right.
Unfortunately, this year,
that
everything has zagged.
Right.
And that has been the occurrence to a greater degree every time we've had market drops really over the last decade, really since 2008. You're seeing fixed income and more aggressive stock funds become a little bit more correlated. Maybe not to the same degree, but there is an increased correlation between the performance of the two asset classes.
Yeah, we've talked in quite a few of our podcasts this year about how historically the bonds were the safe haven when the markets were going down. And that's where that, in the 60-40, that's that 40%. So to Eric's point, this year, instead of one zigging and the other one zagging, they were all correlated. They all zigged, or they all zagged, whatever you want to call it.
And don't you think that it was sort of like in the middle of the year this year, or even earlier, like a late spring-ish, where at one point everybody's like, oh my gosh, the stock market's down. And really, when we dug into the performance, it was the fixed income is where we saw the greatest losses. And that's unusual, because most of the time, when you have a market where there's a little bit of trouble in the equity markets, there has a tendency for flight to security or flight to safety. And what that simply means is that when you have a flight to safety, is that money flow. So new money or existing money has a tendency to flow to different fund types, and that's tracked. Yep. And when the markets are great and the markets are really good, there's a flow to equity markets or the equity funds. When there's a flight to safety, when you have trouble markets, money flows to the fixed income market. But this year really was one of those time periods where we struggled. Boy, it was struggling trying to find safety anywhere.
Well, and what we've heard, all the news heads and people have talked about the 60-40 is dead. You've heard that one a million times this year. The problem with it is normally, yes, that flight to safety, you move to that income side so you don't take the hit, which of course we did take the hit this year. The concern is that income side does not grow back at anywhere close to the rate that the equity side does during a good, healthy market. So that's been the worry, is when the market does recover and start going back up into a healthy bull market, the money that you had on that income side is just not going to recover as quickly.
Well, that's always been the talking point throughout this year with clients is when you lay out the fact that the problem this year has not been the stock market, and we've talked about this at length, but the problem this year has been bonds, has been the bond market, hands down. It's one thing if you're 25, 30 years old and you've got an aggressive portfolio and you're down 30%. Yeah, it sucks, but no one's going to cry a river for you. If you're a conservative investor, you're a year or two, or maybe you're a year or two into retirement, and you've got that safe, balanced portfolio like you're supposed to have, and according to history, historically speaking, always does well.
Right.
There's no one in our position is ever going to tell you, no, that's a bad idea, generally speaking, to go a little bit more conservative, not totally, but a little bit more conservative into retirement. Those portfolios have been dragged down significantly by the performance of the bond portfolio, by the bond funds. In some cases, because I think some people view bonds as like this static asset. That's not the case. You have just as much diversity within the bond portfolio or bond options as you do within stocks. You have mid-cap, small cap, large cap stocks. You have international, you have emerging markets, you've got domestic, right? You have all these different categories of stock funds. You have them all on the bond side as well within the fixed income portion. High yield, treasuries, municipals, right? You have all the international, domestic, short-term, long-term, mid-term, right? You have all the same diversity within the bond categories.
Right.
And universally, they were all down in double digits, which is unheard of.
Right.
And so it's just been a really, really rough year.
Well, I would tell you that, I've been in the business almost 20 years, and it's rare to see when you have the market or the economy heading to a recession, which is what we did. First and second quarter of this year, we head into recession. Markets were kind of weak. Typically, when you find that, you have the Federal Reserve that's more in a quantitative easing or more of a dovish approach, where they're sort of lowering rates to say, hey, we're going to kind of spur the economy along by lowering the borrowing rate or lowering rates so that the banks, in theory, would give you a lowering borrowing rate.
Right.
But what we saw was it was the opposite.
The opposite, right.
So we had the economy slowing down, or not really slowing down. I guess maybe potentially during a recession it was slowing down, but it was very slight slowing. But anyway, we were slowing, and yet the Federal Reserve was being hawkish or being super aggressive or tightening the monetary policy. So however you want to phrase it, that's unheard of. We hardly ever see that. It was kind of a perfect storm.
Perfect storm, that's what I was thinking.
Yeah, perfect storm, if you will. So that being said, we have had conversation after conversation after conversation. It's almost every Monday morning we talk ad nauseum about portfolio construction. What are we doing? What do we think? And to be honest, we obviously don't know any more than anybody else, right? We just get the same data that anybody else would get access to. But we made a pretty good call back in April to limit our exposure to fixed income. We did. Yep. That was good. And then in July, we made another transition in the portfolio to increase our cash position and also almost eliminate our traditional fixed income, except for a couple little small holdings, but for various reasons we held on to it. But we eliminated that piece of the portfolio to a pretty good degree. Now, our conversations have been, again, ad nauseum. I mean, it's every week we're having these conversations, but it is, what is our view of 60-40 moving forward? Because this is one of those situations that, moving forward, we hope we never run into another situation like we're in right now where, the markets are the economy's kind of struggling, markets are kind of slow down, and yet the Federal Reserve is not being cooperative. And so we've had to sort of change our thought process on what does 60-40 look like moving forward. We've had these debates for years. Eric, I know you brought this up 2 or 3 years ago. We were kind of like, just keep, same old, same old. It's always worked. But I think we're all starting to come on board now of, okay, maybe there's something to this, that we sort of change our approach to the traditional 60/40 and view it more like risk on, risk off assets. Now, that's not a technical term that we decided to really use, but it's something where it's a whole placeholder. Maybe we use it moving forward, I don't know. But it's a placeholder to say, what do things look like well, I'll ask it this way. If we looked out 5 years from now, 3 years from now, what do you think a traditional 60/40 portfolio, what is it going to look like? What do we, from a risk on, risk off asset pool? What is that going to look like?
Well, hard to tell what it's going to look like 3-5 years out, to your point, but the things that we traditionally would use on that income side are changing. So one of the first ones that we're looking at, as long as the Fed is being hawkish, you're getting these, very high interest rates. That's bad if you're borrowing, but it's pretty good if you're the one doing the lending. So that's where you get into short-term government bonds, for example, which are arguably as low risk an investment as you can when it comes to investment risk, because these are backed by the federal government. So historically, these were not really good investments because they just didn't pay anything. Right now, you've got short-term T-bills paying out in excess of 4%. So that is a risk off that is paying out at a rate that historically is a whole lot better than what you can get at the bank. So that would be the first one.
Yeah, what else, Eric?
Yeah, and I think, just to piggyback on what you were talking about, using the terms risk on, risk off, ultimately that's what a 60/40 portfolio is.
Yeah.
The 60 is the risk on, the 40 is the risk off. Whatever the stock portion of your portfolio, that's always risk on. And it's not necessarily just about risk off, it's about volatility control as well. So I think ultimately what we've been trying to focus on this year is adding a little bit more volatility control into our portfolio, specifically for what would constitute the risk-off portion of a client's portfolio, especially as it relates to creating an income plan as you're entering into retirement. So to further what you were talking about, we've been using a lot of short-term, T-bills and bonds, 4.5% interest rate on a 9-month, even on like 9-month CDs right now is unheard of in my lifetime. And I was born in 81, so I guess actually maybe the very beginning of my lifetime, you were able to get comparable rates on short-term instruments like that, but certainly not anywhere in my recent lifetime, professional working lifetime. Right. But we've been looking, if rates are increasing on short-term government debt, they're also increasing on things like insurance products, and the bad A word, annuities, right?
Yep.
And nothing crazy or sexy about any of it, but when you look at a fixed annuity, those are the most vanilla of annuity products out there that you can look at. Once again, you can get 4, 5, 6%, 2, 3 year, 5 year fixed annuities. Yeah. Nothing sexy, nothing crazy about it, but if you want that volatility control, it removes the volatility. You're getting the freedom of knowing, or I guess the luxury of knowing what your return's going to look like, barring an insurance company collapse or something like that, which is highly, 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 highly unlikely. Once again, it's all about adding stability or reducing the amount of volatility within your portfolio to whatever degree that might constitute that quote unquote 40% of your portfolio. It's more or less about ensuring, as much as we possibly can, less volatility for really the next 8 to 10 years within your portfolio as much as we possibly can. Anything beyond that's going to go back to the risk on assets.
Right.
Yeah, the one piece I would add to that is that traditionally speaking, we've used the part of the portfolio that's more geared for fixed income. We've used that as a tool to produce the income that we need to distribute out to the owner, okay?
Right.
Yeah. And so what we've now seen is that fixed income piece, we can solve that issue by creating more assets that are more risk off, meaning or a great reduction in risk, as opposed to traditional fixed income where we're like, it just produces an income, we distribute the income. What I think we're moving to, and this is why it's a little bit of a debate with us, is can we create a pool of money that is already cash? So there is no risk whatsoever. And maybe instead of having 6 months worth of cash in a portfolio or carrying 2% in cash or 3%, which is your traditional model, right?
Right.
3% cash, 47% fixed income, 37% fixed income. Sorry.
Math
Nothing like doing math on
math
the
is
fly.
hard.
Right?
Yeah, and then 60 equity. I think what we may wind up with, and again, I'm looking out 2 or 3 years from now, is that we have a pool of money that is either cash or cash equivalents, and it could be 5 or 10% of the overall portfolio.
Right.
Whatever the cash need is for 2 to 3 years, we want that to be cash or cash equivalents. It's not just the 2% anymore. It's that cash is there, no risk, no volatility whatsoever, so you don't have that bond fund going up and down. Now, historically speaking, they haven't gone up and down very much, but recently it's had huge swings, and we're getting to the mindset of let's just have some cash there, cash equivalents, and we know it's not going to make very much, but we know it's cash, and that's the pool that generates this income, and then we can have stuff that maybe we need cash 3 or 4 or 5 years from now. We can use an instrument like a treasury bill or something like that that says that money will come due when we need it. Right. And so again, this is sort of developing. We're continuing to have those conversations, but I think it really is interesting that we start to have these conversations with clients and the podcast watchers, just to say the old historic 60-40. I think Eric, you might be right several years ago when you brought it up. I'm not saying it's dead, but I'm saying all of us that manage money have to view that differently. And I think we're taking the right approach to say, let's look at this a little differently. We have risky assets and we have assets that we don't want to have a whole lot of risk, if any. And that's really what we're trying to develop.
I think the summary of that would be the 60-40 is not dead, but it is changing. And the way that you traditionally would have done it is just not going to be as effective as what it once was, to Eric's point from a couple of years ago.
Yeah, I mean, we talk a lot about the science versus art.
Yeah.
Right? There's a science to what we do. And the science is going to dictate that, obviously depending upon the situation. But if your situation calls, depending upon your risk tolerance and time horizon and all those other things, all those other factors, if a 60-40 portfolio is appropriate for you, then yes, we still want to use a 60-40 portfolio. What constitutes that 60-40 portfolio, what we're using for the 40, what we're using for the 60 is constantly changing. We don't live in 2019 anymore. We don't live in 2008 anymore. We don't live in the 80s anymore, right? The times change, and we have to make sure that we're changing and adjusting our strategies inherently within them. We can't continue to do the same thing every single year, regardless of what kind of noise is going on about us. It's not like we were doing anything terribly risky, or we were doing very effective things before. But if there's a way for us to tweak what we're doing to the smallest degree, when we're creating retirement income plans, then we're going to take advantage of what the market's given us, and we're going to adjust as needed, based upon obviously any individual's current situation.
Yeah, so let's just kind of wrap it up here. So any kind of final thoughts on, someone that maybe is viewing their 60-40 portfolio and they're working with somebody that's not started to have these conversations about what a 60-40 portfolio might look like?
Yeah, and I'll go first, because I think we just want to, what I really want to hammer home is the idea of volatility control. How can we reduce volatility within your portfolio over the next 8 to 10 years? That's it. What can we do to reduce volatility? We're not taking out any risk. We're just changing the type of risk inherent in your portfolio, and we're trying to reduce that volatility as much as we possibly can. We're not saying go all in on one strategy or go all in on the other, but given what the market's, what they're producing right now and what we anticipate will be, what they'll be giving us over the next couple of years, we're not seeing much in the way of volatility control when it comes to what the Fed's deciding to do every month, every quarter. They're not showing any signs of becoming more dovish with their policy. Hopefully they will, but there's a reason that they're doing it.
Right.
And you can go back to our podcast a few months ago when we talked about the Fed's putting us into a recession, and that's not changing. They're still planning to do that. We're going to have a greater recession in 2023. And so that's why it's very important for us to make sure that we are eliminating volatility or reducing it as to the greatest degree that we possibly can when we're trying to create a stable income plan.
The times they are changing, and that's That's not now. That never has changed. If you are not making the changes, if you stick to the way things you've always done them, it's a matter of time until that catches up with you. And I think this is a great example of it. I mean, even in our world, think about companies that were extremely powerful not that many years ago that are virtually non-existent or are gone now. Xerox. We used to talk about having a Xerox room in your office.
I'm going to give you a great stat in just a second.
Okay.
Go ahead, finish that thought.
When's the last time you've heard of Xerox? Because they didn't adjust with times. That's no different when it comes to the way that you invest, the way that you distribute your funds during retirement. The way that things have always worked doesn't necessarily work anymore. And you have got to change with those and make those adjustments, or you're going to get left behind.
What's so if you were in the 80s managing money, you were probably picking individual stocks, right?
Absolutely.
And there's still some old school advisors that do that. We don't really do much of that in house, but you were talking about the giants of the industry, and the giants of the industry over the last, let's say, 5 years have been the FANG stocks: Facebook, Apple, Amazon, Netflix, Google, right? I saw a stat that blew me away this morning. Texas Roadhouse, local company, restaurants everywhere, right? But if you're in Louisville, then Texas Roadhouse is based out of Louisville. Wonderful, wonderful organization. I was a server there in college. It's fantastic. Fantastic place to go get a good steak. Cinnamon butter rolls are awesome.
Yes, they are.
But over the last 10 years, their stock is outperforming Google. Google has nosedived in the last year.
Wow.
If you look on a 10-year chart, Texas Roadhouse has outperformed one of the behemoths in the industry. Not because they're sexy, they're not flashy, they're just kind of slow, steady, right?
Consistency.
Consistent output over the last decade. If you were a stock picker a decade ago, doing your job with all of the resources available at your disposal, no chance you would have ever chosen Texas Roadhouse over Google. Times change, things change, but you can't look at every single, to your point, that the greatest of giants eventually will come down. And so I found that stat super interesting. It really blew me away when I saw it today.
That really blew me away when you said that.
I would have never guessed. Anyway, so that's it for another edition of the Money Puzzle. Make sure you tune in each and every week, which we supply material, and we talk about different financial topics, and usually relevant. So we're trying to stay as relevant as we possibly can. I think we're doing another one coming up here in a few minutes, and it's going to be on a topic, I believe, we haven't talked about it yet, but I believe it's going to be with a client meeting we had, or a prospect meeting we had a couple days ago, which is incredibly interesting. It has all kinds of different facets to it, mostly don't do's. But anyway, we'll get more into that next week. But Eric, you want to sign us off for this week?
Yep. Thanks for listening. Thanks for watching. If you're watching on YouTube, make sure you subscribe to our content. Be the first to get notified whenever we drop anything new. And, of course, you can listen on whatever podcast station that you choose to listen to our content. We're available on all available platforms: Spotify, Apple, whatever. So thanks for listening. Thanks for watching. Visit our website if you'd like to schedule a call.